So the government of India has just released the economic growth numbers for the second quarter of the current financial year. The second quarter refers to the months of July, August, and September. And the data shows how India's economy essentially did in this period. It was widely expected that India's economy and its GDP, which is the sort of the market value or the price of all the goods and services that are produced in India over these 3 months, that quantum will grow by something like 6.3, 6.4, 6.5%. And broadly, market expectations have come true. The latest data shows that India's GDP has grown by 6.3% in the second quarter. Now, if we break down the GDP growth, we find that, looking at the data, we can figure out what are the different engines of this growth. What are the different ways in which India gets this growth. And we find that there are four big engines for GDP growth. There is private final consumption expenditure, which is the expenditure that you and I make. And then there is government consumption expenditure, which is the expenditure that government does. Then there is investment expenditure, which is done mostly by private sector. If a private sector firm builds something, buys computers, even government, when it builds a bridge, that all comes under this. And then there is this element called net exports, which is essentially a net effect of how much do we export and how much do we import. And what the data shows is that, let's look at it one by one. The private final consumption expenditure is the biggest engine for growth. It's the biggest determinant of GDP. And we see that, if you see in the yellow line, and we see that, between the same quarter last year and the current year, the private final consumption expenditure has grown by 9.7%, and which seems like a very decent number to grow. But immediately after that, to see it in perspective, if we look at the data and compare it to what it was in FY20, which is the financial year ending in March 2020, which is just before the pandemic, we find that the private final consumption expenditure has just grown by 11.2%. So, when you compare it just over 1 year, then the growth number looks really good at 9.7. But if you compare it over 3 years, it has grown by 11%. So it just shows you that, where we are relative to where we were, in terms of private consumption. The second data that we can look at similarly is government consumption. And we find that not only government consumption has come down in this quarter over the same quarter last year, but if you look at the last, pre-COVID phase, it's down almost by 20%, which is a significant thing. It basically means that government is not spending as much. GDP goes up when everybody in the economy spends a lot. And at one level, it was expected that government would be spending more because private consumption was curtailed because of COVID and its effects. But government consumption over the last 3 years has actually gone down by 20%. The good news in that sense is that the investment expenditure has gone up by almost 21%, which is the blue box which you can see in the change between FY23 and FY20. And the net exports number has gone up quite massively, and that basically is because we are importing more than what we are exporting. It has a minus sign, which basically shows that we are importing more than we export. And it going up, that next net export numbers going up, is never a good thing, because it just means that our GDP overall will be dragged down, because we are actually spending more. Money is flowing out of India than coming in. And that's why, if you see over the pre-COVID period, the growth has been only 7.6. So you can either feel happy about the fact that India has grown in this quarter at 6.3%, or you be more realistic and understand that it has just grown 7.6% over the last 3 years over the same quarter, which is a far more muted growth in that sense. And the other changes, if you compare these 3-year changes, which we've done for FY20 over FY17 and FY17 over FY14, we find some perspective of how much should any of these engines should have grown by recent record. And it just puts into perspective how much have we grown in this quarter. But the second big thing that sort of comes out from so-called GDP data is the GVA data, gross value added. And actually, for quarterly data, it's the GVA data that matters more than the GDP data, because what is actually observed in real life is the GVA data, which is now on the screen, and not the GDP data. GDP data is calculated by looking at GVA, and then we add to GVA, we add the taxes that the government earns and the subsidies that and subtract the subsidies that government gives. So if the government is earning more taxes than it's giving subsidies, then GDP will be higher than GVA. That's broadly the equation. And typically it so happens that GDP is higher than GVA because the government earns more taxes than gives the subsidies. So now look at the GVA data actually gives you a sectoral health check, as it were, of India's economy. It has data for agriculture, mining, manufacturing, construction, services, all kinds of services, financial services, trade and hotels. And it gives you a certain sense of where the value is being made, in which sector is the value being made, where are people actually earning money, as against GDP, where we are looking at spending. So if you look at GVA, the clear positive is agriculture, which has grown by 4.6 over the last over the same quarter over last year. It has grown by 4.6%. Overall, GVA has gone up by 5.6%. But the worrying part in this is the manufacturing story. You look at it over just year-on-year change, it has contracted by 4.3%, which means that we produced less value, 4.3% less value in the manufacturing sector this year, in this quarter, second quarter, as against the same quarter last year. And if you look at, say, the change over FY23 over FY20, which is the pre-COVID period, we find that manufacturing value addition has just grown by 6.3%. If you compare it, say, to the FY17 to FY14 change, which is another 3-year period, the value addition had gone up by 31%. So it just shows you how much has manufacturing actually struggled. It actually has started struggling, as you can see from the data, from FY17 onwards, has largely not grown. And that creates a big issue because manufacturing is where a lot of jobs are. Another positive point, as it were, on the current year scenario is the 14.7% growth that you see in trade, hotels, communication services, those kind of services. As the COVID restrictions went away, all those services sort of improved, and they've grown by almost 15%. But a reality check is where they are relative to pre-COVID period, and there you can see it's just 2.1%. So pre-COVID, when you compare it to what it was pre-COVID, we're just above higher by 2.1%, and all of this has it just shows you the kind of stress that the sector has faced over the last 3 years, and how many job losses might have there been, and the kind of hit that businesses would have taken in the services sector. A couple of other worry points are, say, the mining and quarrying sector. It has contracted by 2.8 just year on year, and over 3 years it has just grown by 2.5. It had actually contracted between FY17 and FY20, financial years 2017 and financial year 2020. So mining and quarrying continues to be a sector that is struggling, and even financial services. You can see say, it has grown by 7.2 year on year, 7.8 total over the pre-COVID period. But if you compare it to what it was doing, it was growing at 42%. It grew by 42% between FY 14 and 17. So it just shows you what the potential of the sector is and how muted we are at the current juncture. And finally, on GVA also, overall, we have grown by 5.6%. But if you look at it over pre-COVID, over 3 years, we've just grown by 7.6%. So that just gives you a certain sense of where India's economy is. For a more detailed look, please go to indianexpress.com and read the stories there. Thank you.